Hi friends, welcome to the class on CAFM. The first topic is your basics and understanding on strategic financial management. So the moment you say financial management, what does that mean? What actually is financial management? So basically, or the layman term, so basically very simple meaning of financial management is managing your financials. Now, what is the meaning of strategic financial management? It means managing your finances in such a way that it helps management to take strategic decisions. You would have heard of this word, strategy. So this is something very important term, strategy. It means it's a particular something pertaining to a decision making aspect, some input pertaining to decision making aspect. So in this subject, strategic financial management or financial management, you will be dealing with multiple concepts in finance management which helps management to take certain decisions. That is why it is called as strategic financial management. So here, financial management, if you see the definition, it says that it is an ongoing process that helps a business to reach its long-term goals. It's an ongoing process, dear friends. There is no stoppage for that. It goes on forever. Every day there will be something to learn. Every day the business organization needs to take certain decisions. Every day the management of the company needs to take certain decisions. That is where the strategic financial management applies to the business. And then what is the second part to that? And then if you see the continuation to this definition, you can see that, simply put it, it's about making sure what your company can do matches with what the market is expecting, what the market actually needs. Dear friends, this is also very important. Any business entity should operate to meet its market expectation. Any company which does not operate, which meets its market operations, then the company cannot survive. The business cannot be met. The business cannot survive. So that is why it is very important. So strategic financial management means, on the first place, it's an ongoing business. It's an ongoing activity which helps a business to take certain decisions. At the same time, ensuring the business performs the way the market is being expected. The market is expecting from the business. So that is what is called as strategic financial management. So the next concept, dear friends, what is the difference between finance management and strategic finance management? So there is certain difference. Is there any difference between finance management and strategic finance management? What is the difference? So here if you see the first difference, the financial management is all about framing of financial plans. So there is something called as financial planning. There is something called as financial budgeting. There is something called as financial forecasting, financial estimating. So framing up these type of plans is called as financial management. So example is financial plan. Similarly, now what is strategic financial management? It is all about applying tools and techniques for measuring the business strategies. So this is very important, dear friends. So in your exam, you need to highlight of this part. So whatever is highlighted, this is very important. So any tools and techniques that has been used for measuring your business strategies, those are called, those tools, applying of those tools, applying the knowledge of those tools is called as strategic financial management. So in this subject, you will be learning more about strategic financial subject, where how you can actually contribute to your business, how you can take decisions in your business. I hope this is very clear with respect to difference between financial management and strategic financial management. Just to summarize, financial management means majorly focusing upon financial plans, whereas strategic financial management means applying certain tools and techniques such that those help to frame certain business strategies. So that is the difference between financial management and strategic financial management. So once we understand the difference between finance management and strategic finance management, let us see what are the components in strategic finance management. So these slides give us about around 7 strategic components. What are those? The first one is financial decision. As I was telling, strategic finance management always focuses on decision making. It focuses on how a decision needs to be made, what parameters needs to be considered for taking certain decision. The tools and techniques are being applied by the business entities, by the management of the business in order to take certain decision. That is why it is called as, and those type of decisions which are taken using finance management is called as strategic decisions. So the first component of strategic financial management is strategic financing decisions, the decisions which are based on finance. Finance means money. Any decisions related to money is called as financing decisions. Here when I say financing decisions, what exactly it means is how much money the company requires, how much company the business requires, how much money does the company require to raise from its investors. So those type of decisions are called as financing decisions. This can be in terms of equity share capital, this can be in terms of raising money from debenture holders, it can be in terms of raising money from preference share capital, all of these things, or it can be borrowing of money from different bankers. Any type of decision can be taken under strategic financial management. So these type of decisions are called as financing decisions. We will discuss more about this in future slides. Next one is managing growth and risks. Friends, it is very important to know that every business entity has certain phases in its business growth. So it's always growing, business always grows. When you are saying a business is growing, it means that it can move from one phase to another phase. For example, there is a company which operates only in Bangalore. So Bangalore is the capital of Karnataka, all of us know. Let us assume this particular company operates only in Bangalore. Now, the company starts its new office in Hyderabad. Then it slowly starts one more office in New Delhi. It starts one more office in Chennai. It starts one more office in Mumbai. If you see, the business is growing slowly. When this, for taking decisions pertaining to this growth, let's say for example, should a company open a new office in Delhi or not to open? Should the company expand its business from Karnataka, that is Bangalore, from Bangalore which is in Karnataka to Andhra Pradesh? So there is supposed to be a decision that needs to be taken. So these type of decisions can be taken when strategic financial management tools and techniques get applied. So that is why another component to financial strategy components are managing growth and risks. So what do you mean by risk, friends? So when this growth is happening, there will definitely be certain risks. Let me give you an example. Now, I have a company in Bangalore. When I am expanding my business to Hyderabad, what is a major risk that I face? Language barrier. So I have a risk. Until and unless I have a team who is strong in that language, we cannot work over there. We cannot hire employees who are local over there. We cannot deal with customers who prefers only those languages. So these type of risks also needs to be considered, and converting these risks in terms of money. So that is what we understand over here. So basically managing growths and risks. The third component is cash flow management. Friends, what do you mean by cash flow, friends? Cash in and cash out. For any business, when it performs a business activity, there is certain cash that comes in, there is certain cash that goes out. So managing this cash is called as cash flow management. In accounting, you would have studied about this. Cash flow statement. Cash inflows, cash outflows, cash from operational activities, cash from financing activities, cash from investment activities. So then cash balance at the beginning of the year, then you arrive at cash balance at the closing of the year. So this, if you see this cash flow statement here, if you will see only the cash based transactions. How much cash is coming into the business, how much cash is going into the business, from where is this cash coming? Is it an operational activity, is it an investment activity, or is it a financing activity? These are something that you will be observing in case of cash flow management. Then next one is working capital management. So now we spoke only about cash flow, now we are talking about working capital. What do you mean by working capital? Current assets minus current liabilities. When you say current assets, it includes your short-term assets. When you say current liabilities, it includes your short-term liabilities. So, total current assets minus total current liabilities will give you working capital. So, how is a business going to manage its working capital? You might understand, why is this working capital concept important? What is the role of this working capital concept? How do we understand this? So friends, when you're saying, when a business tries to manage its current asset, it means that all those assets which are likely to convert into cash in a short term period, all those liabilities which require cash from the company during a short term period. So how better is the business to manage its short term assets or short term liabilities? How better is the business capable of meeting the short term liabilities cash outflow with its short term assets is called as working capital management. Never mind dear friends, you will be going deep into this subject. I am giving a very brief explanation for these concepts. Next one is dividend decision. What do you mean by dividend decision? Dividend means a share in the profit which is given to the investors of the company. In other words, shareholders of the company get certain profit share called as dividend. So now who pays the dividend? Company pays the dividend. Who takes decision to pay the dividend? Company's management takes decision. When I say management, who all comes in management? It is basically key managerial personnel. Key managerial personnel means CFO, CEO, director, managing director and senior managers and various other managerial people. All of them will be considered as key managerial personnel. When those people are taking a decision whether to pay profit share to the shareholders or not, those are called as dividend decisions. Next one friends, investment decisions. So the moment a company is operating, when the company is actually growing, it needs to make lot of investments. The company also gets lot of investments. So when those investments also needs to be decided by the management, so for those decisions you need to have certain inputs. So those inputs will be driven from strategic financial management. So these are the 7 aspects or 7 components of strategic financial management, which is also important to be known. In your company secretary examination, this question can be asked, what are the 7 components of strategic financial management? Briefly explain. So then you can give this 7 aspects and then explain about them. The next concept we will be discussing is EBIT and EPS analysis. What is EBIT, EBIT? Earnings before interest and taxes. What do you mean by EPS? Earnings per share. Before that, I will just show you how to calculate EBIT and how to calculate earning per share. So this is something very important based on which various concepts will be coming into picture. Computation of EBIT or computation of earning per share. How do you do? First is your sales. Sales minus variable cost. Yeah. First one is your sales. Sales minus variable cost will give you something called as contribution. This contribution minus fixed costs will give you EBIT. Please note friends, what is full form of EBIT? Earnings before interest and tax. What is full form of EBIT? Earnings before interest and tax. So what is the formula to calculate EBIT? Sales or revenue or turnover minus variable expenses. When you do sales minus variable expenses, what is it you are getting? Contribution. Contribution minus fixed cost, you are getting EBIT, that is earnings before interest and taxes. Once you get earnings before interest and taxes, now what should you do? You should reduce interest from the EBIT. So EBIT minus interest will give you earnings before tax. EBT. EBT means earnings before tax. What is this interest? What do you mean by interest? So whenever a business borrows certain money, whenever a business takes loan from a lender, for that loan the business has to pay something called as interest amount. So that interest is to be reduced from EBIT, earnings before interest and taxes. So you reduce interest, you are going to get earnings before tax. So friends, this is very important to note. This format is very important because this format will be your like basis for multiple problems and questions that will be solving going forward. So how do we calculate EBT, that is earnings before tax? Sales minus contribution, which will give you, sales minus variable cost, which will give you contribution. Contribution minus fixed cost will give you EBIT, earnings before interest and tax. EBIT minus interest will give you EBT, that is earnings before tax, and earnings before tax minus tax will give you earning after tax. Earnings after tax is also called as profit after tax. So this is the format, which is basically a golden rule. It is very mandatory that we need to remember this format. Once again, I'll explain. Sales minus variable cost will give you contribution. Contribution minus fixed cost will give you EBIT. EBIT minus interest will give you earnings before tax. Earnings before tax minus taxes will give you earnings after tax or profit after tax. Now, how do we calculate earning per share? Earning per share is nothing but profit after tax or earnings after tax divided by total number of shares issued to the shareholders or total number of equity shares that are outstanding. So friends, in this concept, EBIT or EPS concept, earnings before interest and tax or earning per share concept, this is the formula. So the next concept is earning per share. What do you mean by earning per share? Earning per share is nothing but profit after tax or earnings after tax divided by number of equity shares that are outstanding. Number of equity shares issued to the equity shareholders, that is called as number of equity shares outstanding. Therefore, earning per share is equal to earnings after tax, profits after tax divided by total number of shares that are outstanding. So friends, EBIT and EPS, this concept is very important, wherein multiple decisions will be taken. We will also solve certain problems based on this concept. Let us try to understand what is the use of this earning per share. Earning per share means earning per share. Earning per share means generally what is the profit portion that is available for one single equity shareholder. That is why earning per share formula is equal to profit after tax. The profits earned by the company after payment of taxes, interest, everything. The profit portion is being paid to the shareholders. Each shareholder will get certain profit portion. That profit portion is nothing but earning per share. Okay, how do we value this company? How do we value a company based on earning per share? So there is a formula. If you look at here, there is saying that market price of the share divided by earning per share will give you value of the company. Very simple. So friends, this formula is very important in case of valuation. Valuation of the company is equal to value of a business entity is equal to market price of the share divided by earning per share. So once again I will repeat. How do we calculate earning per share? For calculating earning per share, you need to identify what is the profits available for shareholders. Profits available for shareholders divided by total number of equity shares will give you earning per share. Now, how do we calculate profits available for shareholders? Profits available for shareholders is nothing but profits after tax or earnings after tax. How do we calculate this profit after tax? So, sales minus variable cost will give you contribution. Contribution minus fixed cost will be giving you EBIT. EBIT full form is earnings before interest and taxes. EBIT minus interest amount, that is the cost of borrowing a loan. That interest amount is reduced from EBIT, then you are going to get earnings before tax. So, earnings before tax minus taxes will give you earnings after tax or profit after tax. So, this profit after tax divided by total number of equity shares outstanding will give you earning per share. So, this earning per share, now what is the use of this earning per share? Earning per share is being used to value a company. How are you going to value a company, dear friends? So, there is a formula for that, which is basically market price per share divided by earning per share. So, this is nothing but market value of the company, or another way for it is market valuation of the company or market capitalization of the company. So, this is the concept of earning per share and how it is used to value a company or value a business entity. In financial management, it is important to note that there is something called a series of activities which needs to be evaluated financially. That is when a decision can be taken by the management of the company. So, let us take for example any business. If I want to sell a product, let us assume I am going to sell a particular pen. When I am selling this pen in the market, I need to purchase certain raw material for the pen. The purchased raw material will then be processed or certain manufacturing activity needs to be conducted. Post manufacturing activity, once the pen is ready, then I will have to use my sales team, take help of my sales team and then sell the product in the market. If you are observing over here, there is a purchasing activity, there is a manufacturing activity and there is a sale activity. And each of this activity happens one activity after another activity. One after other, each of these activities will be happening. So, this linkage of each of this activity is called as value chain analysis. So, that is where this concept of value chain analysis comes into picture. So, if you see over here, what do you mean by a value chain analysis? It is basically a series of activities of a company that are evaluated financially. And then a decision is being taken with respect to which activity of the company needs to be improvised, which activity of the company needs to be, certain additional efforts needs to be made, or certain financially is there any investment that needs to be made, is there any aspect that needs to be taken into consideration so that the company's final operation is proper. Let us say for example, the product I am selling, if a customer gives me a feedback saying that the material is not good, the quality of the pen is not good, now I need to see under which activity it went wrong. Did the activity of manufacturing go wrong, or did my raw material purchase went wrong? So, once I get to know this, then I can change my decision with respect to what needs to be done in order to have a proper quality pen. So, that is why we will be studying about this concept called as value chain analysis as a part of our financial management, wherein we get into in-depth analysis of each and every activity of a company will be completely, thoroughly analyzed and then certain decisions will be taken by management. So, now we understood what is value chain. Now, let us try to understand what is value chain analysis. When you say analysis, it is also something similar to this, wherein each and every activity is analyzed thoroughly. During that analysis, you get to know certain information, what needs to be improvised, what needs to be corrected, what financial decision needs to be taken, how should teams work in order to improvise that performance, what action needs to be taken by the management in order to have a better outcome or output. So, that activity is called as value chain analysis. Just going through this definition over here, it is basically an evaluating each of the activity in a company's value chain to understand where opportunities of improvement lie. So, that is very important. What are the aspects wherein improvements can be done so that your overall output comes in an efficient manner, productive manner, qualitative manner. So that is what we will be understanding with value chain analysis. Now let us try to understand what are the different components of value chain analysis. So now, after understanding the concept of value chain analysis, let us try to see what are the components of value chain analysis. As I was telling you, value chain analysis means a series of activities. A series of activities means a series of components that get involved in value chain analysis. What are those components? Let us see. So these components are segregated into two parts. One is primary components, the second one is secondary components. So what are these primary components? Primary components are nothing but your primary factors, very basic components in any value chain analysis, any value chain of a company. So these primary components are so important for any company because those are mandatory requirement for the company. So what are these primary components? What are the different primary components? The first component, if you see, it is inbound logistics. So friends, you would have heard this term called as inward freight, outward freight. So what do you mean by inward freight, dear friends? The transportation that is being incurred, the transportation that is being used for bringing the material to the production place. This is called as inward freight. Friends, this is very important activity. Just imagine, how will the raw material reach the manufacturing premises? How will the material or goods reach the production premises without having inward freight? So that is why this is one such component that is very important. Now you can tell me, sir, in financial management, what is the role of this inbound logistics? Dear friend, this adds up to the cost. When you are saying inward freight is charged to your cost of goods sold. When it is added to your cost of goods sold, means it is determining what is the gross profit of the company. So that is why if this cost increases, your gross profit reduces. If your gross profit reduces, your profit after tax reduces. If your profit after tax reduces, your earning per share reduces. If your earning per share reduces, your valuation of the company reduces. That is why this inbound logistics is very important component of a company, which is forming part of the primary component. So the second component in value chain analysis is manufacturing operations. When I say manufacturing operations, what happens in manufacturing operations? The raw material that has been procured, the labor that has been acquired, and the inventory that is already accumulated, those will be used in the manufacturing process, and then an output product is generated. So that is the concept of this operations. So this manufacturing operations is also very important component in a value chain, so which forms the second component in value chain. The third primary component in value chain is outbound logistics. So friends, what happens over here? Inbound logistics happens. Raw material comes to the factory. In the factory, operations are performed where a product is being manufactured, and once the manufactured product is ready, it is sent to dispatch. It is dispatched to sale. It is dispatched to the selling location. This is called as outbound logistics. So inbound logistics was there, then operations got carried out, then there is something called as outbound logistics. So after outbound logistics, the fourth component is marketing and sales. Now the product has reached the selling location. Now somebody has to do advertising of the product. Somebody has to do marketing activity for the product. Somebody has to make this product marketable. Promotion activities needs to be done. So that is called as marketing and sales activity. So which is also primary component but important component. So the fourth component in value chain analysis is marketing and sales activity. So friends, the final product, the fifth component. So we told in a value chain analysis, there are two types. One is primary components, secondary components. Under primary components, there are 5 components. The first one we discussed, inbound logistics. The material is coming into the factory. Once it comes to the factory, the manufacturing process happens. Once the manufacturing process happens, the material moves out of the factory. It is called as outbound logistics. Once it has moved out of the factory, the product is ready for the sale. There should be certain manufacturing selling activity that needs to happen. For that, promotional activity, advertisements and marketing activity needs to happen, and then now product gets sold. After the product gets sold, there is something called as post-sale service. So it is mandatory that service needs to be provided. That is called warranty services, or basically guarantee services. You all know that, right? When you purchase a product, you get warranty for that. What does that mean? During the warranty period, if there is any problem with the product, there will be service provided. You purchase a bike, there is some issue, you get 3 free services from the company for the bike. Similarly, you purchase a laptop, you have a warranty period of 1 year. During 1 year, if your laptop gets certain repair, they do it for free of cost, or they'll replace that part, they'll replace the laptop with new one. So this is called as service portion. So with this, friends, we understood 5 components which are primary components which will be there in each and every manufacturing entity. Now you can ask me, in finance management, how are these 5 components relevant? How are these 5 components important? As I was telling you, in any business entity, all these 5 components are mandatorily required. If they are mandatorily required, there is certain cost being incurred on each and every component of this. When there is cost incurred on each and every component of this, it is necessary for the management to take certain decisions. As we were seeing, what processes are going wrong, under what stage there is some issue, and then accordingly they will be taking certain decisions so that they can make a corrective action. Let us assume the sale of this pen is not happening in a proper manner. Now I will see, is there any problem in inbound logistics? Is there any problem in manufacturing activity? Is there any problem in outbound logistics? Is there any problem in marketing activity? Is the pen not being advertised sufficiently? Or after selling this pen, there are a lot of issues that are coming in this pen and we are not able to provide proper service. So this is the chain called as value chain, especially in case of primary components. Now let us move to secondary components. What are the secondary components? So till now we discussed about primary components. Now we are moving to secondary components. What are the secondary components? Secondary components are nothing but support activities. In a value chain analysis, friends, there are 5 primary components and then there are certain support activities for these primary activities. So what are those support activities? Let us discuss one by one. So the first one, if you see, technological development. See, as you all know, in a value chain analysis, for any business entity, technology is also very important. There are many situations. Let us take for an example. You purchase a phone, iPhone 16. Dear friends, please note, within the next 6 months' time, a new model gets released in the market, which means there is a new technology coming into picture. A new technology replaces the old technology. Any product you take, be it cars, be it any electronic components, be it laptops, be it your cell phones, technology is actually playing an important role. Suppose if you don't rely on technology, what happens? If you don't develop your technology, if you don't invest in technology, what happens? Products become obsolete. Many of you know this case study. There used to be a company called as Nokia. Even now this company is there. So basically today if you see in the market, you see lot of smartphones of Samsung or Apple or various other companies. But how many smartphones of Nokia are you actually seeing? Why? Because Nokia was slow in adapting to this technology. That is why technology plays a very important role. The second component, human resources. What do you mean by human resources, dear friends? Human resources, HR, is nothing but your employees, is your people. So, employees who actually work in the company so that they deliver certain efficiency to the company and the product is actually meeting the requirement of customers. So, human resources is also a support activity. So, the first support activity, what was that? Technology. The second one is human resources. The third one will be your infrastructure. What is this infrastructure? Infrastructure means your place of work, your factory premises, your machinery, your fixed assets. All of these things fall under infrastructure. You tell me, can we perform a manufacturing activity without any machinery? So, machinery is needed, machinery is important for any manufacturing activity. That is why this infrastructure plays a very important role, being as a support activity in value chain analysis. So, with this, dear friends, we conclude the topic on value chain analysis. So, just to summarize everything, a value chain analysis means a series of activities, lot of activities which as a financial management, what happens? The management of the company looks into each and every activity of the company, then identifies if something is wrong in any of the activity. Simple. Now, components of value chain analysis. There are primary activities, there are support activities. There are 5 primary activities. The first activity happens to be inbound logistics. Material is coming into the factory. Once material comes to the factory, manufacturing operations falls. So, manufacturing operations is the second primary activity. Then outbound logistics. This is the third primary activity. Once material is going, the manufactured product is sent to the selling location. At the selling location, what should you do to have sales? You should perform certain marketing activities. So, marketing activities is the fourth primary activity. Once the product is sold, then the company provides service to the product. So, this is fifth primary activity, that is post sale service, warranty, guarantee. So, these are called as post sale services. So, we discussed about 5 primary activities, then comes your support activities. In support activities, one of the support activity which we discussed is technology. We said technology plays a very important role. Without technology, things will become obsolete. Otherwise, it will lag behind. The second support activity is human resources. Human resources means employees in a company. So, the third support activity will be your infrastructure. When I say infrastructure, it means it can be building, it can be machinery, it can be assets, it can be fixed assets. It's basically the premises at which manufacturing activities can happen. So, with this, the topic of value chain analysis is complete. There is another important concept in financial management which is called as leverage analysis. See, this term leverage may be a new term that is being used. What do you mean by leverage? It's basically what it means. What it means is the funds that have been raised by a business entity. If the funds that are being raised by a business entity is in the form of something which makes the business entity pay interest to the lender. So, that is called as leveraging. Friends, it is very important to note what exactly is a leverage. Let's take an example of a loan. Bankers provide loan to a business entity. When business entity borrows loan from the bankers, business entity is obligated to pay interest to the bankers. So, loan is a component of leverage. Let me give you another example. Shareholders give capital to the company. This is called as share capital. Now, if any share capital, a funds is raised in the form of share capital from the shareholders, will business entity pay interest to the shareholders or pay profits to the shareholders? business entity only pays profit to the shareholders, they don't pay interest to the shareholders on their funds. Hence, the capital raised in the form of equity share capital is not a leverage. Did you understand, friends? So basically, when a business entity has an obligation to pay interest to the fundraisers or fund issuers, that is called as leveraging, and whereas any form of fund that has been raised which has only profit share and there is no interest commitment, that is not forming part of leverage. So this concept, leveraging analysis or leverage analysis. What does this concept say? If you see the use of fixed charges sources. What is this fixed charge, dear friends? I was telling, a fixed commitment, interest. Fixed charge means interest is charged on the business for the amount of fund that has been borrowed by the business. That is called as fixed charge. So now going with the definition, the use of the fixed charges source of funds such as debt and preference capital. See, concept of preference share capital also, there is a fixed rate of profit share that needs to be given. There is a fixed charge. That is why it is also forming part of leverage. Preference capital along with the owner's equity in the capital structure is described as financial leverage or gearing or trading on equity. These are different terminologies. It's called as gearing, financial gearing or financial leverage or trading on equity it is called. So basically what it means, there is something called as capital for any business. In the balance sheet, you have something called as fixed assets, current, that is non-current assets and current assets. Other side of your balance sheet, you have something called as capital, non-current liabilities and current liabilities. Leverage analysis means what is the portion of your capital, what is the portion of your non-current liabilities. So this is called as leveraging. In other words, leveraging involves management of the company to take a decision with respect to how much portion of the funds should be borrowed by the lenders, how much portion of the funds should be raised in the form of equity share capital. So this proportion is called as leverage, and analyzing this proportion is called as leverage analysis. I hope you understood this concept. So now we understood the concept of leverage. Now let us come to the aspect of financial leverage. So as I was telling in this definition, when you say financial leverage, it means that what is the commitment of the company towards interest payment? What is the commitment of the company towards certain funds that has been raised in the form of loans? And what is the funds that has been raised and company has no commitment? So this type of analysis will be considered as financial leverage or financial leverage analysis. So if you see the financial leverage, this part, the financial leverage employed by a company is intended to earn more return on the fixed charge funds than their cost. So friends, basically financial leverage analysis means you need to perform an analysis of your funding in such a way that the return earned, the profits earned by the company is better than the cost being incurred by the company. That is what this sentence says. I'll just once again repeat it. The financial leverage employed by the company, the loans that have been borrowed by the company is intended to earn more return, is intended to earn more profits. The loan borrowed by the company is intended to earn more profits than the cost that are incurred by the company, than the cost of interest that is incurred by the company on these loans. So this is called as financial leverage, and financial leverage is actually very important under financial management because any company will be raising certain capital. Any business will be raising certain funds in the form of loans. Any business will be raising funds in the form of preference share capital. Any business will be raising funds in the form of by issuing of debentures. That is why this financial leverage concept is important. Now that we understood what is financial leverage, let us try to understand different components of financial leverage. So, the first component, dear friends, it is called as debt ratio. What is this debt ratio? Debt ratio is nothing but what is the amount of debt the company is having when compared to your entire funds that has been raised by the company. So, the formula for debt ratio is very simple, dear friends. So, debt ratio is equal to total debt borrowed by the company divided by total funds raised by the company. When you say total funds, it includes equity capital as well as the loans borrowed by the company. So, this is the formula for debt ratio. So, why is this important? Why is this important, dear friends? Just think. Let us say, suppose I have raised total funding of 100 crore or 100 lakhs. Let us assume 1 crore I have raised funds. Of this 100 lakhs, I have borrowed 20 lakhs, which means my debt ratio is 20%. What does it mean? It means that for my business, I have a leverage of 20%. In other words, I have a debt of 20 lakhs out of 100 lakhs of funds. What does that mean? It means 100 minus 20, which is equal to 80, is nothing but my equity capital or share capital or any capital that is not having fixed cost, fixed rate of interest. So, that is this 80. So, in other words, I have raised a capital of 20 lakhs in the form of loan and 80 lakhs in the form of equity. Did you understand, friends? So, that is the concept of debt ratio. See, are you observing here? We spoke about financial leverage. What did I say? What is financial leverage? Financial leverage means analyzing to what extent of your debt that has been borrowed or something that is having a fixed cost of interest is yielding a return better than the cost incurred. So, over here I am saying that my debt ratio is 20%, which means that my borrowing is to the extent of 20% of my overall funds. If 100 rupees is my capital or 100 rupees is the funds that have been raised, it says that 20 rupees has been borrowed and 80 rupees has been raised as equity capital. So, that is the concept of debt ratio. Let us now try to understand the other ratio, that is debt equity ratio. The next ratio is debt equity ratio. Under debt ratio, we said debt ratio, total debt divided by total funds, whereas debt equity means debt equity ratio is equal to total debt divided by total equity. So, this is the difference. Are you identifying any difference over here? In the first formula, when you said about total funds, it included your debt as well as your equity. In the second formula, numerator is same, that is your total borrowings is forming part of your numerator, whereas your denominator you are having only equity. debt is not forming part of your equity. So that is the concept of this second formula. So debt equity means the portion of the debt that has been borrowed over the equity capital that has been raised by the company. So that is where the second ratio comes into picture. So that is the difference, dear friends. Don't get confused in your examinations or in your interview questions or any of your campus interviews or any of wherever you're going, job interviews, wherever it is, please don't get confused. Debt ratio is different, debt equity ratio is different. When you say debt ratio, it means total debt divided by total funds. When you say debt equity ratio, it means total debt divided by total equity. The next measure of financial coverage is interest coverage ratio. What is this interest coverage ratio? It means that what is the profits that is earned by the company which is capable of covering the interest. I will give you an example. So basically I will tell you the formula so that it helps you to understand what this that coverage ratio is. Total EBIT divided by interest income. Let us say we know that. How do we calculate EBIT? EBIT minus interest will give you EBT minus taxes will give you PAT or EAT, profit after tax. If you see here, your EBIT, I mean interest is being reduced from EBIT. In other words, your EBIT should be sufficient enough to take care of your interest burden. So, interest coverage ratio is how much EBIT do you have in order to take care of your interest liability, interest obligation. That is why the formula of interest coverage ratio is interest coverage ratio is equal to EBIT divided by interest. Let us say, for example, interest coverage ratio is 120%. What does that mean? If my interest is 100 rupees, my EBIT is 120. My EBIT is 120 times my interest. So, I can take care of my interest burden. If my EBIT, I mean interest coverage ratio is only 80%, what does that mean? My interest liability is 100 rupees, whereas I have EBIT of only 80 rupees, which means my EBT, earnings before tax, is negative. So, my profits are not sufficient to take care of my interest. I am not able to cover up my interest obligation. My interest coverage ratio is less than 100% or less than 1. So, when you say 80%, it means it is 0.8. It is less than 1. If you say 120%, it means it is 1.2. It is greater than 1. So, interest coverage ratio of any company should always be greater than 1. If it is greater than 1, it means that it is capable of taking care of interest obligation. If interest coverage ratio is less than 1, it means that it is not capable of taking care of interest obligation. Simple, friends. I hope this is clear with respect to interest coverage ratio. This is also very important. So, basically what is that interest coverage ratio? See, why are we discussing about this? We were discussing about this because we are talking about financial leverage. When you say financial leverage, to what extent do you have a financial burden on loans in the form of interest obligation? That is where this concept of interest coverage ratio has come into picture. So, as a part of this interest coverage ratio, we said what is the capability of the company or the business entity to take care of its interest obligation. That is where this interest coverage ratio comes. The formula for interest coverage ratio is equal to EBIT divided by interest. Why you are taking only EBIT? Why are you not taking EBT? Because interest is deducted from EBIT. Interest is not being deducted from EBT. EBT is coming after deducting interest. That is why you are supposed to take EBIT in the numerator and EBT or PAT will not come in the numerator. Is it clear? Good. Now here, coming to these three ratios. So basically, what are those three ratios? Debt ratio, debt equity ratio and interest coverage ratio. If you see here, the first two measures of the financial leverage can be expressed either in terms of book value or the market value. What is this book value? What is this market value? Book value means the value of the assets and liabilities that are recorded in books of accounts. The value of assets and liabilities that has been recorded in your balance sheet. Market value means the actual worth of assets, actual worth of liabilities. Let us say, for example, I have a land. I have purchased this land probably 10 years back. When I purchased my land of 10 years prior, I have accounted it as probably 10 lakh rupees. Friends, 10 years back, if I purchase a land for 10 lakh rupees, do you think the price of the land will still remain same as on date? The land value appreciates. Probably the land value is now 60 lakh rupees. Now, what do you mean by book value? Book value is nothing but the value at which the land has been recorded in your books of accounts or balance sheet. That is called as book value. Market value means the actual worth of land as on today, if at all you are selling that land in the market. That is called as market value. So here, friends, what it is saying is the debt ratio or debt equity ratio can be recorded either at the book value or it can also be recorded at market value. It depends from case to case basis. Okay. Then the third measure of the financial leverage, commonly known as coverage ratio. This is a reciprocal of interest coverage and is a measure of the firm's income generating capacity or income gearing capacity. So basically what it means is interest coverage ratio is capable of determining what is the capacity of the firm, what is the capability of a business to take care of its interest obligation. So that is why it is very important. See, if you are understanding this concept of financial leverage, you should try to understand that it is very important for decision making, to what extent you can bear the interest obligation, to what extent you can actually borrow money, to what extent you can actually raise funds in the form of capital instead of borrowing obligation. Did you understand, friends? So with this, we will be concluding this topic. Any queries or any questions, please feel free to comment below. We will definitely reach out to you and address your queries. Thank you, friends. Bye-bye.